All right, we're live. Let's see. Attendance. Nobody has joined just yet. So as they start to join, we'll...
Yeah, we're getting there. 22, it looks like.
Oh, 22, they're there. Everyone. There's everyone. All right, perfect. We'll kick things off. We'll probably give this another minute or two.
Yep.
See Jack Pizzino. There we go. Good to see him in the mix. Runs a great mastermind event. Let's see, anybody else that we know on here? Any familiar faces for you there, Scott?
A few here. Yeah, obviously you know Jack as well. Let me see here. Keith Ginzer.
We got a Mike McCrary on here.
Justin Young.
Could be Hall of Fame Baltimore defensive end Michael McCrary.
Jim Ross, of course.
Give it another 1 or 2 minutes.
Yeah.
Where are you calling in from, Scott?
Indianapolis.
Perfect. Home base, the home podcast base.
Yep, it is.
Did you making a renovation there the last time we were chatting?
Yeah, a little bit. Not too many updates recently. Mostly this is where we do podcasts from, webinars, and really about anything. I also have another area over here that we do stuff in. So yeah.
Cool. Just about 30 here.
Okay. Yep.
I'll say it again for folks that have joined, but we've turned off the Q&A for this. So any questions that you have, feel free to pepper them in the chat. And we will do our best to answer them. We're gonna run this not quite like a podcast or a webinar. This will be kind of town hall style. We've got some content here that we've collaborated on. We're gonna work through it together, and we do want to get the audience in the mix if they've got questions throughout. It's a dense set of material here. We don't want it to be presented in the form of a lecture. So. Open to participants. But to that end, why don't I kick things off here? I think we're starting to develop a little bit of a critical mass. Thanks for joining today, Scott. My name's Peter Smyth. I'm the co-founder and CEO of White Label Storage. We're a third-party manager. We started in 2023 on the heels of a company called Local Locker. It's really a retail self-storage business in New York that we run remotely. We found that that business lends itself well to third-party management for non-institutional assets. Started managing a few assets remotely around the country, and kind of we're off to the races. And throughout our growth journey, we met Scott through self-storage investing and mastermind. And we were lucky enough to be on, I guess I've been on your podcast a couple of times now, Scott.
Yeah. Mm-hmm.
Would love it if you'd introduce yourself here before we dive in.
Sure. Also been in the business for a while, just a little longer than Peter. We've been at it since 2005 is actually when I got into self-storage. Been investing in commercial real estate for over 30 years. And we've done a little over 5.3 million square feet of self-storage over the years, 34,000 units, and still developing, still growing, and now doing this internationally as well. And yes, have an investment company as well as an education company and a mastermind. So sort of all things self-storage that we've been involved in over the past several years, and it's been a wild ride.
Scott, when did you start the mastermind and education side of the business?
Yeah, the education side started in 2007, and then our mastermind came on just about 2015 was the first year that we held our mastermind. And that was just kind of an evolution of the education side of the business as we were graduating our folks and allowing them to become successful self-storage owners. And they were still wanting to stay involved in the community to be able to learn and grow, and as they grew and scale. And so the mastermind was born.
So you caught you got this thing started before the pandemic. You caught the wave there. you had all the new participants and new entrants.
Yeah, we've been through the Great Recession, we've been through the pandemic, and the ups and downs of the economy. And the beautiful thing is that storage continues to do well no matter what's going on in the economy, and always providing challenges regardless of what's happening. But gosh, this asset class in this industry has been one that's just been very good and very resilient no matter what's going on in the market.
Perfect. Well, that is a good segue into the content today. What we're trying to talk about, it's an idea I've had for a while, and Scott and I have talked a lot about this, but we encounter so many different assets throughout our business, and there are businesses that are performing well for the right reasons and performing well for the wrong reasons. And so one of the things we're trying to do today is really diagnose, is it the market or is it the operation? How do you look at an asset that's underperforming and figure out, is there something I could do to improve performance, or is this an asset that I should walk away from altogether? And that'll sort of segue into best practices and technology that you can leverage. It was nice collaborating with Scott on this. When we put stuff together, I've done a few of these now, and maybe anyone who's participated in something I've done before, like I think about everything through the lens of a framework. If you're thinking about something or analyzing something and it can't be described in a framework, then you probably don't fully understand it. It's a way to simplify sort of a complex problem. So that's the key thing we want you to walk away from this webinar today with, is a framework. Want to dive a little bit into the market and operations, kind of what performance drivers are at the asset, how to maybe look at underwriting a little bit differently after this webinar, and then what are some action plans and best practices that you can put in place if you are an asset owner and you do have you're facing some adversity at the asset level or in the market. So I'll just start here. In order to understand what's wrong, you need to understand how to look at it. The way I think about management, and we've had to change our approach as we've grown our business. As a small business, you have people doing different things. You grow. You have to segment people into buckets and sort of centralize functions, and I think that's the same thing that can be said for any storage operation. So one of the things that a complex organization will force you to do is understand what are the primary activities, or what are the buckets, what are the single threads of responsibility at the asset. I think about these things in really 4 primary operations at the facility level, and starting at the top, it's marketing. Where do the leads come from? What is the outbound effort? What is sort of standing, stagnant, unpaid effort that you're making to generate new leads? Moving through the funnel, there's customer service. How are you fielding leads? How are you communicating with your tenants? That's kind of the tip of the spear. And then at the asset level, once a tenant arrives at the facility, what does it look like? How are you upkeeping the facility? That's your maintenance. And then finally, how do you extract value from the tenant? What's your revenue management practice over the long term? Everything can kind of fall in these 3 buckets. Now, you can approach things differently, but the core framework here is, these are the core activities. What are the supporting activities, and what is the org chart, and what's the infrastructure that you put in place to tackle those things? Is there anything, do you think about things differently? Do you have different buckets, Scott, that you would kind of place things in? How does this sort of resonate with you?
Yeah, I mean, at the facility level, which is what we're talking about today, you hit the nail on the head. I mean, these are the things that we look at, and so obviously there's a lot that goes into this. I immediately jump to as from an owner standpoint, when I look at revenue management, it's all based on NOI. So we're looking at not only top line revenue and how to manage that revenue, but how do we keep the expenses down while doing everything else here. So that's I guess the call it the 5th component, or just another way of looking at the numbers is from an NOI standpoint. But that's a topic for another webinar.
Yeah. And as Scott said, there are other, if you're an investor, you might have investor relations, you're putting out K1s. There's obviously the accounting. On our side, we have us, but the that we are managing on behalf of. So let me dive in. Did I cut out there, Scott, for a sec?
Yeah, just for a second, but not too much. I think we picked up right where you left off. We're good.
All right. So let's start at the top of the funnel here, marketing. the way I'm thinking about this is really, in order to understand an asset and its performance, what you're trying to do in diligence, or what you're trying to do when you understand your asset, is figure out, what does good management look like? What would a competent manager do? And am I performing those responsibilities? If you are, and you're still not executing against your underwriting, it might be a market problem. So this is sort of a framework that I've put together, sort of high level and maybe intermediate level questions and responsibilities that are a quick test on competency and a smooth operation at the property level. So on the marketing front, first things first, a high performing website. Website these days needs to be bookable and mobile friendly. So one way to test that would be renting an online unit. I mean, really, what you're looking at is kind of like the non-customer service side of a secret shopper. So most facility management softwares and website providers today are going to be kind of adhering to best practices. Scott, what do you use for your assets, or do you kind of divvy it up around?
Yeah. I think what we use for our assets is not Scott. And what I mean by that is, I think it's real easy for folks to, as you point to, verify how everything's happening, trending unit online, and a high performing website. And I know we have a varied audience on here, but I think we all are guilty of thinking, well, I can, let's look at what Public Storage is doing, Extra Space, or any of the other bigger players out there, and then let's try to replicate what they're doing. But I'm going to make it better. I'm going to put my own signature on something. And at the end of the day, we should be reverse engineering what the most successful companies are doing that have the amount of marketing dollars and prowess behind them, and not try to reinvent the wheel. It's when we're going out and producing, content for our own website, we need to stay out of our own way. And so I would also say, when you want to verify, looking over to the right-hand column, whether it's happening or not, send somebody else to look at your website other than yourself, because we as owners, we want to put our stamp on and our fingerprint on everything in the business. And just because we think it looks good and we think we can do it better doesn't mean that it is a high-performing website. And so I think that's where people sometimes get tripped up. So, depending upon, and I'm not going to specify one vendor over another. We use roughly 3 when it comes to our websites, but they're easy. They're easy for somebody to be able to understand, see what type of, the items that they're going to store in it. There's a fresh picture of that. They can see it in a unit. There's pricing, square footage, and, within a few clicks, they're able to reserve a unit or rent a unit. It doesn't have to be anything more than that. So I think simple is best, simple and clear.
Perfect. Yeah, I mean, you kind of touched on something there that I think is important. If you're looking at an asset and it's run by Extra Space and you're in diligence and it's not performing well, I think Extra Space or Cube, like, those are pretty good proxies for competent management. It's the same as if you're ever looking at an apartment in diligence. If Greystar is running the facility, that's probably going to look like market performance. And that's what we're trying to do here, is like, what are the things that a competent manager would do? So these are the quick tests. So search your facility on Google, search storage near me in your market. Do you show up? Check listings across major directories. That is one of the major drivers of SEO performance. Do you have consistent information? And one like nuanced check there is, are your store hours the same on Google as they are on your website? Like, that is somebody that's on top of their game. That is a competent manager, and that's just another arrow in the quiver of the manager when you're looking at, okay, this person's on top of the ball. And then finally, look at the Google reviews. They'll tell you a lot. They'll tell you a bit about the maintenance and the facility in general, but they'll also tell you about response time.
And to add to that, Peter, as well as driving Google reviews as well, there should be some type of incentive in place for our managers to then incentivize our tenants, our clients, to put a Google review out there. So there's different ways of being able to do that. But this business right now is putting a whole lot of merit on Google reviews. We're looking at that more than we have in the past probably 10 years or so. It's just a very good indicator of when people are looking at a facility. That is a very good indicator of how well you're going to show up versus your competition.
Yep, perfect. Moving on to customer service. Again, thinking about the customer service bucket, you could build this thing into a grid, like an Excel spreadsheet or a grid. Just check the box for each one of these things, and if this is a activity that's unaccounted for, you have a problem. And the more of these that are unaccounted for, the more you have an operational flaw at the facility level. So call the facility at different hours. The most important thing for us is both answering the phones, but then getting back to the tenant on a missed call. Those are we have SLAs in place for our call center. We need to pick up 80% of our calls in 20 seconds or less, and we need a 95% pickup rate. If we aren't hitting those, it's not just business as usual or try to figure out what's wrong. We have to staff up, because if that compounds day after day, you're going to miss leads, your conversion rate's going to go down, and that's kind of the core metrics at the customer service level. And by the way, I would imagine that many of the audience here is maybe like a single store or multiple store owner where you have somebody on site, and that person might step away from the facility or from the front desk for a couple minutes to go do overlocks or unit sweeps. That's fine, but that's where you start to look for maybe technology as a solution to fill the gaps, whether it's call center or AI. Scott, you sound like you have some thoughts on that, or maybe some war stories.
I don't know about war stories other than, well, first of all, I guess I need to make it clear to everybody that we've used white label storage, or using white label storage, and you guys are on it when it comes to calling back. The call center is on it, and that was one of the things that was just key for us. Tenant issues not being addressed quickly. That's that was my gas, because there's nothing that makes me more frustrated than the whole idea behind running a successful facility in terms of occupancy is keep what you got and get a little more. And there shouldn't be any reason why somebody should leave, but that they will leave if we're not taking care of them. And so, yes, we absolutely make sure that there's nothing that, I shouldn't say nothing, but that is one of my big pet peeves, is that, we've spent all this money, we spent all this time getting these folks in here. Just take care of them. It doesn't take that much to take care of them. So making sure that any issue is addressed quickly, and then just they can step in. We empower our managers and our management companies to just step in and keep these folks happy and make sure that they don't leave. There's no reason for them to leave if they do, other than they just don't need the storage anymore. We certainly don't want to be the cause of that.
Yep, and again, we're trying to diagnose the problem here. So there's a lot of ways that you can staff this. It could be AI doing a great job. Sometimes I would say for the most part, you can tell if AI is answering the phone, but it can do a great job on certain types of calls. It could be somebody onshore, it could be somebody offshore, it could be somebody at the facility. We have our preferences. It's not about everybody doing the same thing. It's just about how do you achieve kind of a minimum viable result here and then improve upon it. I will say at the customer service level, I have never seen somebody field a call better than a good on-site person. So if you do have someone on site, I would at least think about that person playing some sort of sales role. And if that's not in their wheelhouse, I'd maybe think about other ways to kind of staff the facility. And I say that because nothing competes with or better than just native knowledge about the facility, understanding where the units are, what the kind of idiosyncrasies are of the facility. Those people just close better. So, and then kind of last piece here, again, back to mystery shopping the process, but interactions with customers, are things sort of slipping through the cracks, whether it's Google reviews, how fast are these things responded to? Or one way you can kind of figure this out is you can secret shop a facility and say hey, how are you going to track this? I've got a problem, or I'm interested in this unit. Are you writing this down? Are you going to get back to me? And you can start to understand what the systems are that are in place. Maintenance, man, this one, there's a lot here and a lot that can be done just by kind of walking the property in diligence. But at the very least, the thing needs to be clean, well lit, and well maintained. Anything other than that, and then you know that it's at least not a priority or kind of a failing operation. It could be a choice, by the way. There are some assets that'll sit 90+% occupancy when they're not well maintained, and that might be a great market. You love seeing assets like that where there's opportunity to improve and the assets kind of got tons of deferred maintenance. Is there a well thought out sort of access control system, hardware, low voltage system for getting people in and out of the facility? How are you overlocking units? So walk the property, test it, maybe even book a unit in diligence and try to figure out like, hey, how am I getting access distributed to me? Preventative maintenance done regularly. Ask for the schedule in diligence. If there is no schedule, and there's at least not a thoughtful operation there, right? Like, what is is somebody using Notify? Is there a checklist, or are we just going on vibes? Look, if you've got somebody on site that can make up for a good system, because a good in-store manager is as good as any system if they've got idle hands and they're proactive. But that's something you want to look into. Security systems, just a vendor list, and then just making sure that everything's working smoothly. And then finally, signage. I mean, signage is marketing as well. That's the one marketing channel that is free and will market for you 24/7. Anything you would add to this?
No, nothing to be overlooked. None of this should be overlooked, and you really covered it with the first to verify, as we discussed. It's drive up like a first time tenant. You should be driving your facility, visiting your facilities on a regular basis, because for the most part, your staff should be keeping it up to the same standards that you have set. But there are some things that an owner is going to take a look at and see that sometimes the staff doesn't, and so you need to be out there at your properties looking at those on a regular basis.
Perfect. And then finally, revenue management. This is where there's probably been most, new vendors or new entrants to the market. And we've even, AI has sort of accelerated this. Like, really, everybody can kind of dynamically price or, run automated ECRI these days. And so there's no excuse for not doing it. We found through our local locker business that you can kind of overthink pricing. It's not that your best piece of data is really, are your own units moving? And so I think any algorithm that is driving your pricing unit, your unit pricing should be based on how many units are you moving. So the most important thing is having one standing rate for multiple months at a time is not great. And you can check that in the software when you're looking at an asset in diligence. That's a good sign of a good proxy for competent management. ECRI is the next thing. This is about capturing the area under the curve. It's not, again, important to come up with the best algorithm, but it is important to look at your tenant base, look at if they're eligible under a certain set of rules every month, and then pushing rates. You don't need to be, this is not me saying push rates on tenants every 3 months, but it is me saying, if you haven't pushed rates in a year, don't wait another day. Just look and just keep moving, because every month that goes by, the market may change, street rates in the market may change. And then when you go to push, that tenant may be sitting above kind of where street rate is. What do you have a best practice there, Scott? What do you look for?
We can talk about best practices and nothing more to add than what you've done right now, Peter. I guess what I want to do here is cover maybe some of the blind spots that we've seen and other folks see, and that is, I think there's many times when we first purchase a facility, it's usually a turnaround, and that's what you see as well. And I think what people fail to do is they recognize that if they are truly turning a facility around, they're making repairs, handling deferred maintenance, they're upgrading signage, security, upgrading the facility, taking it from a C to a B minus, or whatever that looks like. And instead, they continue to, I think instead of pushing rates as high as they could, they continue to try to increase rates to the same level of where the facility sat when they bought it. In other words, they've already, pigeonholed themselves into thinking, well, this is still a C facility. We need to keep rates down here. But understand, when you're elevating and improving the facility itself, well, then you need to improve your rates. And if you have the ability to be in the upper tier, and now it looks as nice as the rest, then don't be afraid to ask those rates, especially if occupancy is rising as well, because now you're adding those things to it that make, you're adding amenities to it. You're cleaning it up. You're adding security. You fence it when there wasn't. You put asphalt in when there was gravel before, and so you need to keep your rental rate increases commensurate with now the new level in which you're bringing your facility up to. Does that make sense?
It does. Yeah. I mean, look, it's not for us. It's just consistent. It's consistency. Like, and by the way, for those of you that are trying to figure out, is a facility running ECRI, there's in Storable, it's called the rent rate report. Every facility management software should show you the last rate change and even the rate change before that. And if it looks like there's some sort of cadence there, then that the prior owner or the current owner is kind of on top of it. If there haven't been many changes, there's probably an opportunity there, or at least it doesn't mean that the tenants will kind of withstand the rent increases, but we have seen, in facilities where there haven't been rate increases over time, like there's usually a lot of room to run there, and a lot of opportunity. Tenant insurance is obviously man. At this point, I'd say online rentals, a real facility management software, and selling insurance or tenant protection those are kind of like table stakes for playing a storage game. I mean, it's the quickest way to run a solid operation. Everybody accepts tenant insurance when you sell it to them. In most markets, you can absolutely require that someone has storage insurance. You can't require them to buy it from you, but for the most part, they'll just buy it from your website when you're selling it.
Yeah, and for those of you who think that you can't do that or are afraid to, thinking you're going to drive people away, we noticed a very little change in our conversion rate when we begin to mandate it, either at the facility level or corporate wide. So don't assume that if you mandate it that you're going to lose a client, especially if you're either your call center agents and or the site manager is very well versed and has been trained in how to, we don't sell insurance, but how to offer it in such a way that it is a benefit. It is not only going to generate more revenue for you, but you certainly are not going to lose occupancy.
And then last two things here: fee structure in place. Just check, is there an admin fee on sign up? Although some markets are cracking down on that. Is there a late fee that's consistent with what's allowed in the market? Are there lien fees generating income? I mean, these are just quick checks for, did somebody set up their software properly? It's absolutely something you should do when you kind of are running a transition. And finally, does the unit mix reflect demand? The funky unit types always overstate vacancy, I find, and it's because they're not thought about correctly. I mean, like 5x8s. I mean, the small units always, people just kind of like fill the excess weird buildable square footage on properties with small units that there's not demand for. Oftentimes I would think about an asset as almost the inventory, not including that, right? Like your gross potential may not include the 55x5s that were built there as a banker's box. Same thing is, by the way, I would add RV parking as well. There's so much excess land on a lot of secondary and tertiary market drive up properties that may not be revenue generating inventory there. I mean, there's just there are some assets where you have to ask, why would an RV ever park here? And it doesn't, just because it's there doesn't mean it's going to be a part of your 90% occupancy that you're shooting for.
Agreed. Good underwriting practice when you're evaluating. 100% agree.
Okay. Physical occupancy, potential occupancy, and economic occupancy. Scott, how do you think about this? I have a problem with economic occupancy in that if you're just going off of for those that don't know, your economic occupancy is your in place relative to your potential. And if you're looking at the economic occupancy of within a facility management software, it will often miscalculate it based on seasonal rates or promotions. So if you are like, man, I just got to for whatever reason if you're in a student market and it's fall and everybody moved out and you drop rates, that's a snapshot in time where your gross potential rent is going to look way lower than it would at other moments throughout the year. And so I just think looking at your average in place and calculating it manually rather than using your facility management software is important to do when you're looking at your economic occupancy. Do you look at that differently, Scott? I mean, I know if you just pull a report, it's going to show you something different every time based on how
It does. And you're right. I mean, I think the further out you go, I mean, you have to look at it on an annual basis, but you're going to see the seasonal fluctuations where the delta is going to be greater during, in the instance that you just mentioned in college towns, the delta is going to be greater in the summer, or excuse me, in the winter than it is in the summer when people are storing things, as they leave college or military towns and what have you. So we look at it over time. I mean, I could give a number of examples of when we've approached folks in college towns for facilities, and we hit them at the time in which the people have just gone back to school and they took everything out that they were storing over the summer. Occupancy's down, and they are compensating the manager based upon new move-ins. Well, that's just running that a little bit more efficiently and looking at the numbers for what they are, which is on an annual basis, and really cyclically over the course of if you can go back in 2 to 3 years, and then you can get a better prediction of what it's going to look like. Then, you can't fool yourself thinking you're just going to raise it up just because of a snapshot in time. You need to look at it over a longer haul to determine what the true value of that facility is and what the true economic looks like over time, not just at one time.
Yeah. And this is not to say that the physical occupancy is, I think this slide may overstate kind of how valuable physical occupancy is. I mean, you do want tenants in units, and in many cases you just, you may get them in. Look, Extra Space pioneered the method of just getting people in at any rate, and then treating them as like test customers once they're in, using ECRI. I'm not sure it's easy to compete with that if you don't have the Extra Space budget or brand. But I would just be thoughtful about what market you're in, what your goal is. Are you a merchant builder that's trying to get this thing full and flip it? I would just be thoughtful around physical occupancy. It does not mean strong performance. It may mean you've bought a lot of that occupancy with high marketing spend through discounts, concessions, and high ad spend and spare foot. So the management reports you should run every week. I mean, this is, again, I am trying to kind of continue to hammer on thinking about this through the lens of understanding an asset. Your management summary, I mean, that's kind of like your facility vitals there. Your delinquency report will tell you a lot. I think for each of these reports, it may be worth like kind of thinking about why the report that you pull may not tell the full story. Delinquency, for me, knowing a lot of the folks that might be on this call is kind of stands out. There are often either friends that are tenants or unique use cases where you've got folks that you don't have all the documentation from a transition, and kind of like 120 plus day delinquency looks high. Like, just remove the outliers and think to yourself, what's my 30-day delinquency and what's my greater than 30-day delinquency, and can I chip away at that over time? Scott, what is there anything you would add here? And is there anything that you demand of your operators to try to get a sense?
Well, yeah, I think what we're going to get into, which is the numbers, is certainly easy for us. Either new operators or operators that don't always look at these reports are saying, okay, well, I can run these things, but what's the benchmark? So, what does it tell me? And so I think that's the main thing. So as you look at all these, these are the five, the holy grail. This is what determines how successful or not your facility is going to be, is if you're putting KPIs behind each and every one of these, and that the folks that are responsible for those numbers are hitting them or not. And not just if they are, then just say, well, it must be a market issue or it must be that issue. You need to be able to hit your KPIs, especially where we find ourselves in the market right now. I mean, we have to, we spend a lot of money to get a lot of these folks in. We don't want to lose them. And once you get behind at a facility, no matter what, in lease up and numbers, if you're behind in your budget, if you're behind in your lease up, and again, especially if you're buying these facilities with private equity and you've got numbers that you need to return to these folks and distributions, then you absolutely have to stay on top of all of these. So it's one thing to just pull the reports. The second thing is, what are the KPIs behind it? And then are the people that are responsible for it hitting them?
Yeah. And that's a good, measurement is one piece of it. Once you measure something, you go back and you start at the top of the framework and you say, okay, what's this report telling me? What are the primary activities and supporting activities? How was I ever going to perform against this? Who's responsible for it, and what changes might I need to make? Then you continue to look at the KPIs and you figure out, have your tweaks, improved your performance, or is this a problem asset, something that has really is like underpinned by the market? Okay, so now you've looked at your asset. I mean, you've gone and you've tried to map out who's responsible for what, how are we running the operation. Then you can start to figure out, what do we have here? Do we have an execution problem, or do we have a market problem? And that's where we're starting to kind of go beyond what's happening at the facility and try to understand what's happening in the market. So a couple of reasons that you might have a poor performing asset or a turnaround project that is going to face adversity is oversupply in the trade area. There's a handful of reports that you can find to understand pipeline in a market. I think, we'll talk about the broader national market here shortly. I think we had a supply problem over the last handful of years, and that might start to kind of clean itself up a bit as new starts have and new supply is kind of slowing. Population in the area, just looking at trade area reports. Is there anything else? What do you use as your primary market report when you're doing diligence, Scott? Radius? Is it Radius Plus? Is it Store IQ?
It's a combination. We've used a Radius Plus for a number of years, and we've used a Tract IQ as well. And it's really boots on the ground and making sure to verify that information. So we start there with that. That's the first blush. But as we put this together and as we talked about this, Peter, I think if you've stepped into a facility, you already own a facility. We're talking about due diligence, but if you own this facility that we're essentially talking about, and it's struggling to make things work, then you probably overpaid for it, and you shouldn't have bought it in the first place because you recognize that there's oversupply in the market. The population declining, there's new builds coming in, and there's economic shifts. So if that's all happened in your long tenure of owning it, then sorry that happened. However, you shouldn't be sitting in a facility in which you didn't do enough due diligence to determine that you stepped into a facility in which this is the case. And so all things being equal in a decent market, then if your facility is not performing, which is the topic of this webinar, well, then it's nothing but an execution problem. Your rates, you're not keeping an eye on your rates. You don't have a digital presence. You didn't hire the right person to begin with, or you didn't train that person. And then you took your hands off the wheel and you're not managing the revenue. And so, most of this, and having done this, not only being in the business for over 22 years, but also teaching people for 20 years, most of the problems, Peter, are just, it's in execution. Yes, there are some folks that just assume and they haven't done the due diligence, and they bought a property in a market that wasn't strong, and they didn't, they were blind to some of these. They were so excited to do a deal, they were blind to some of these market problems. But it's pretty rare. If you do your due diligence, you shouldn't either get into that market or you pay for what it's worth, and then you're going to turn it around and bring it up to the level that it can be within this market, and that's through execution. So it may be a different way of answering the question, but we get our information up front before we buy it. And then if we see that it's getting worse, if the market's getting worse, then you don't buy it. If all things are being equal and it's just kind of stayed there, well, then you pay what it's worth. And if there is an opportunity for some upside later, well, then so be it. You take advantage of that by executing better than the previous owner or the current owner.
And there's often not great data. In many of the markets where we operate, and I'm talking kind of bottom of the pyramid, tertiary, secondary markets, a new facility in a market might be 25% of the existing supply. I mean, these small markets, you don't know how much of an impact a new facility is going to have on the overall demand and absorption in a market, because it is such a small town with so little data. I mean, most of these towns and cities outside of kind of gateway cities, and even in suburban markets, they don't have statistically significant facility data. And so sometimes you are just left, trying to understand. I'm not sure that I would ever take on a new build in one of those markets. I think then you're just stuck understanding, how's the asset performed over time, and if it's solid, and if you think there's upside, then it maybe can withstand a new entrant.
Yeah, I don't want to be the one to test it.
Yeah, absolutely. I mean, a new build, never have your first project be a new build. I would say that is something we've learned alongside of our clients time and time again. Uh, I mean, there's a couple different types of performance you can look at. I mean, I wanted to highlight these two here. You know, you've got the 90% occupied facility, maybe an opportunity where there's I call them kind of like 10% off the top, like a quick squeeze. We'll take on maybe one of the 20 that we have in the pipeline at any given time is just not selling tenant insurance, hasn't run ECRI, hasn't really been thoughtful about what their rates are going to be, or hasn't marketed, is like has an aversion to paid advertising, which by the way, that's an investment in new revenue. Like, that's the number one thing we have to coach our clients on. That's sort of facility A. Those are the facilities, for what it's worth, that I think are the most interesting. I really get scared when I see a facility that's kind of more represented by facility B, which is sitting at some low occupancy and has been stagnant for some period of time. Because even the beauty of storage is like demand. If the demand is there, people will find a way to rent the units. And so unless there's something like glaringly obvious, and that's why we use the framework, and we just try to understand, like, how are things being done at this facility. If you can't find a way to justify that 70% occupancy, then I would walk away from that facility altogether. Unless you have some knowledge about some demand driver in the market that you think will allow the facility to absorb those kind of the last remaining 30%. That would be the one thing I'd say on this call for anybody looking at a new facility is, like, I think a lot of the opportunities that are out there are the 85+% occupied, physical occupied facilities. And that's back to physical versus economic occupancy and everything that you can do to optimize the facility. I think if there aren't bodies in units, you might have a hard time getting them in there, at least on a facility that's been around for a bit.
And Peter, if I'm putting on my educator or consultant hat again, we've worked with so many folks over the years that we've, one of the things we've had to, state over and over again to our folks is that, hey, we're also here to tell you no. We're here to cheer you on and get you into your first facility, your next facility. But many times we have to step back and say, hey, we don't think this one's correct. And that's because many folks walk into a facility and they see that it is being run well. But it's only at 65 to 70% occupancy. And I said, well, let's go take a look at the market. And you find out that all the competitors are at 65 to 70. It's an oversupplied market. Everybody's doing the right things. Everybody's marketing. They got good call centers. They're answering the calls. The market is stabilized at 70%. And so but I should say everybody, but so many people fool themselves into thinking that, I look at slide A or facility A at 90%, or I just, 90% is the number that I see is, being fully occupied and stabilized in the self-storage industry. All the numbers show that from the SSA to ISS and everything else, and say, okay, well, yeah, that's what we consider it from an underwriting standpoint. It doesn't mean that the market's going to support it and that you can, by your efforts, take it from 70 to 90 if a market is overbuilt. And so that is a big misnomer that we have to talk people into, saying, okay, well, yes, there is a physical room in the facility, but there's a room in the market to be able to take that up to that 85 to 90%. So it truly is looking into the rest of the data before making a decision and just assuming you can take it up to that place.
Yep. If you're filtering through assets, I mean, if I'm thinking of myself as like a private equity analyst looking at deals, I would spend more time doing diligence on facility A than facility B. I would have some sort of quick check on, can I justify that 70%? And that's when it looks really interesting. Facility B can have a ton of upside, obviously. But yeah, there's got to be a really good reason that's obvious. Yeah. And that's, again, that's digging beneath the surface here, looking at, are folks running ECRI? Is there some delinquency that's dragging this asset down for some reason? If you can actually at the economic occupancy, again, it's tough to do, but if you can really figure out gross potential rent by looking at either your asset, getting some market data, understanding what you think the rates are over kind of a period of time, if you understand that you're below economic occupancy, you may have opportunity there. And then finally, the fees will tell you a lot. Are people paying late consistently? Is this stuff being waived? If if there's no fee generation whatsoever, it just means that whatever's going on site is probably, not consistent, not, up to speed with modern practice.
Well, let's just call it what it is. We know what that is, Peter. That means that manager has made too many friends with the folks, and that's why there's a delinquency issue, and that's why there's a fee waiver issue.
That's, not to belabor the point, but that is actually a common problem that we have where, you can, especially, like on a typical Marcus deal, like I would want to really look at bank statements when I look at the P&L based on facility management data. If you don't have first of the month or anniversary billing that's happening consistently every month, then you know that the prior manager was maybe taking cash, had some solid relationships, and that's going to be a hard transition. If you can try to that's another reason that you better believe that that there's a lot of upside or that you're getting a discount on the property, because you're going to lose a lot of tenant. Any facility that we've ever taken on that had sort of that style of operation where the owner knew a lot of the tenants and had a lot of side deals going on. If you can sort of tease that out, I would automatically discount the deal 10% based on what the true numbers are that are shown there, because
absolutely,
you're going to lose those folks.
And we're not going to, in the underwriting, we're not going to give them credit for running it poorly, meaning I'm not going to include those late fees as far as income. I'm going to remove those immediately from the underwriting and not give them credit for running their facility poorly, if that makes sense.
Yeah. Yep. That's right. As far as the national market goes, I mean, Scott, you spent a lot of time in education. I don't know if you want to take the lead here. I mean, this data sort of tells me something different than what the slide is actually saying, which is that aren't we lucky to be in an asset class that the worst version of the market is flat or slightly down over a couple of years. Man, I mean, the multifamily world is in a total disarray compared to this.
No, I look at this as being thankful. Every time I see these numbers, and I've seen it as high as 86% recently, just depending upon the data source that we use. And again, if you look at, I think the average break even in the self-storage industry, and that's from Class A to Class C, is somewhere around 67 to 70%. And so, the industry itself is healthy. And again, those are averages. That's not everywhere, and that's not every market. So still thankful for that. And, the markets and the capital markets, they do have a way of self-correction. When we have an inflationary period and there's not movement in the marketplace, there are deals that fall off the table, or there's a pause button that has been hit, and we don't have a lot of new stock coming out. There's lag times here and there, and we saw that back in 22 and 23, but it does correct. And so yes, the starts are down, and we're seeing some concessions burn off as the big folks and the folks that are utilizing ECRI and burning off those concessions and getting rates back up. We're seeing then rates come back up across the market, and we've seen, we follow Yardi Matrix and a number of other sources. Once again, TractIQ is probably who we use mostly on a local basis to determine what our rates are doing. And we're seeing, year over year, same month, year over year, we're seeing rent increases, and we've seen that for the past few quarters. And so that also gives me some encouragement as to what we're seeing in the marketplace right now. So all that, the drops and the new starts, that's all good. 82% is a private operator average, which means that they're utilizing good tools, or they're getting white label storage to manage their facilities, and they've given up doing it on their own, or attempting to. And with the AI pricing revenue lift, that's AI has been quite an effective tool in many areas of our business. But gosh, this is one of them. If you just look at that from a pure operations standpoint, that has been, I think we've got this superpower for a short amount of time until, the rest of the industry catches up. But for those that are utilizing it right now, it's saved an awful lot of time, effort, and money to be able to pinpoint where our facility should be and where it sits within the market in terms of rates.
And it's worth calling out that this is data based on kind of institutional supply. And again, a lot of the stuff that's not the CMBS facilities being related to REIT facilities like that, those are many of the folks that we manage for would not be captured in CMBS data. They don't even have debt on their facilities. And some of this, small business data is interesting as well. So I'd say what that definitely tells you, though, is that the non-institutional managers are trailing the REITs. There's kind of two things at play there. One, institutional REITs tend to play in institutional markets where there's more dense population and more demand,
Mm-hmm.
but they also have an operating advantage. And that goes
Yeah.
back to competency. I mean, like I would say on any given asset, a REIT is going to manage damn near, at the top of the, best
Mm-hmm.
practices
Sure.
compared to anybody else.
Mm-hmm.
And so, you should know that when you're looking at an asset, and when
Mm-hmm.
you're that has REITs participating in the market. I
Yeah.
would not underwrite to their rates. I would just, assume this sort of discount
Mm-hmm.
to
Mm-hmm.
kind of the REIT average.
Yeah. No new news here. I mean, it's been that way for 20 years.
Yeah. And this is more on the same point. Like I think things that moving rates have accelerated, on a national average. I'm also, I sit on an operator. I don't know if you're on that as well. It's like sort of an operator panel every other Friday with a bunch of third-party managers, and
Mm-hmm.
everybody's kind of 10 to 15% up on kind of year over year on the same
Yep.
on past couple months. So that's good, a good sign. And that all just tells us again, like it's a good
Mm-hmm.
industry to be in. But the individual asset is really what you're looking at when you're looking for new opportunities. I don't think there's a lot of structural problems in the asset class, unless I'm sure some of this regulation can keep you up at night.
Mm-hmm.
If anything, maybe stay out of California and stay out of New York.
Yeah. Well, good practice all the way around, and thankfully we have, and probably always will.
Yeah. We got. I think we're doing all right on time here. Got a couple minutes left. I would just make sure, if you want to ask questions, feel free to throw them in the chat. I think it's worth, you have your framework. You want to map out what are the competencies, what are the core activities at every facility, and how are they being achieved. But I would also, make a list of questions you can ask yourself in diligence about an asset. And if you can't answer these questions, you need to go get the answers to these questions. And if you don't like the answer, then think harder about whether this is a deal for you. Are there competitors in this submarket that are also struggling, or is it just this facility? Run the same set of diligence or questions that you can do from sort of the outside via secret shopping and market studies to understand the other assets. That can tell you a lot and is a good way to compare your own facility. Is there new supply coming on in the next 12 to 18 months? That data may be good in some of the kind of larger markets, maybe hard to understand in a tertiary market. And if that's the case, could you withstand new supply coming online down the street? Has anyone tried professional management before? Again, what would a good manager do at this facility? And if a good manager has managed this facility, what does that tell me about the poor or solid performance? And are you a good man? Are you going to continue managing the facility like a best-in-class operator? The rate gap, again, understand the REITs. I think the best thing to do is understand a store that looks most like your own. How is that store performing? Those are the rates you should be looking at, unless something is like directly across the street. It's really, what is the same store product, and is a REIT across the street for me? If yes, then those are my rates and not a dollar higher than them. And then finally, does the market support growth? I mean, if you're going to crank rates, is the income are the income levels there? Can you sustain growth over the long term? And if your underwriting relies on it, you need to be pretty confident for a number of reasons. Technology. I think the first three things here, or at least the first two, if you don't have online rentals and you don't have a facility management software, like you're not really kind of up to date with where the market is today. Any facility that's not, it used to be that I would look at assets that did not have a facility management software or a website and see that as mostly opportunity. But now sometimes I wonder, is that a sign of broader problem? If a manager doesn't have facility management software or a website, like, is there going to be some sort of deferred maintenance or structural issue at the asset, because that's just somebody that's probably not paying close attention to the asset? A lot of noise about AI. I mean, Scott, I don't know what you've done at your assets. I mean, for us, most we think the most effective way to use AI is on data retrieval and analysis, and then customer service. So really, for us, that means pricing and fielding certain types of calls at the store level. Whether it's
Yeah, I mean, we call it the customer journey, and we're just, how much do we release AI and let AI handle pieces of the customer journey? And so I think it's that reminders, data being pushed out, call it billing and reminders for late. Yes, I know there's a number of platforms out there. Ours, the one that we're on, being one of them. That can automate and handle the entire, lean process as well. I don't know that I haven't seen it done as effectively as we would like, so we're not going to turn it completely over to that. But yes, there are significant pieces to the customer journey that AI is handling and getting better at it. This is another one of the discussions that we had. I was in Bangkok 2 months ago at the SSA show for Eastern Asia, and had a discussion with a number of operators. And the question is, do we really care? The question I pose is that, do we really care? Do you really care if you call in for whatever service it is? Call it a self-storage rental, but anything that if you get a really good agent that walks you through the process, if it's a low labor intensive process like renting a storage unit, do you really care that it's AI versus a person? I mean, if they're good and they're efficient, I make the argument that it's better than some of the other areas in terms of a customer service or that journey that we have with other services and companies out there, in which there's a latency in the ring. You get switched over several times to somebody that you can't understand them because of their accent, and only to find out that they can't handle you. And so you start the process over when they switch over to somebody else. I would rather get to the end and having rented a storage unit or fixed this customer service issue I had by an AI agent that handles it the first time in 5 minutes, versus getting the runaround for 15 minutes. And so that is, I think that's one of the bigger discussions that we're having in our industry right now, which is, do we really think that our clients care as much as we think we do? If all we're doing is trying to get them from A to B, and we're doing it more efficiently than a human being, then why wouldn't we do that? And does the customer care? And the answer that we're finding now is that they're getting used to it. They understand it. And so we can tell if it's an AI agent. Oh, I can tell it's an agent. Yeah, but did they march you through and get you what you wanted? If the answer is yes, then why are we making such a big deal about it?
That's right. And I would only care if I couldn't escalate myself out away from the AI.
You got to have an off ramp. Always has to be an off ramp to get to a live person.
That's right. We demoed this. So you and I talked about this, Scott. Like when we first launched, so the way we attacked it is really, where do we think AI can do as good of a job as a person, or be faster than the person? And for us, the first version of that is get pricing for someone or take payment from someone. I mean, those are just there's always perfect information there. Answering any sort of customer service or customer complaint, that's kind of non-deterministic. We want people handling those calls. It'll probably get, I think it will get there. I'm not going to pioneer that on an asset, given that we're in kind of a fiduciary responsibility. But but yeah, I think right now those are the two use cases we've cared about. And then delinquent dialing it's been huge for us. Just calling, tracking people down. I mean, like if you can have somebody around the clock, just calling folks that are behind and just trying to chip away at getting them on auto pay, like that really moves the needle for us. And just saves time. And can happen at all hours. I mean, that's the beauty of AI, is there's like 4 or 5 phone calls that always happen after hours that may be somebody trying to make a payment. And if you can take those calls every single time, that just compounds over the long run.
And the outbound reminders for those delinquencies. I mean, you can making all those simultaneously, hundreds of them simultaneously. I mean, you don't have to employ agents to do that, live agents to do that.
True. Well, we just found, man, and that goes to this question here, is like, what management software has consistently delivered the best ROI for independent owners operating 1 to 5 facilities? Gosh, look, I think they all. There's probably not a true measurement of ROI there. I do think if you're going to look at one of these things, you should look at the payment processor as a hidden fee that can really add up, especially on a large store. But I would just demo around and just see, I think it's honestly, it's preference on how do you intend to run your facility and what do you think the interface feels like? I mean, the biggest pain in the butt is really setting the facility up, going in every day, making sure that the emails are being sent out correctly when people move in. I just would go very deep in a sandbox to try to understand how what the UI looks like. The 800-pound gorilla is storable. They have three, even at storable, they have 3 products. I think their best product is easy storage. I mean, it's like the UI on that that facility management software is really good. But it's the cheapest, but it's not great for scaling across a portfolio. So to answer this question, Dallas, I might point you there first. Cubby is kind of the most modern operator and new entrant that's growing the fastest, because I think they have a lot of really slick tools and add-ons that are kind of integrated within the platform. They've got AI agents built in. I know Storable's kind of deploying the same. So I think it's just a matter of really you mapping out how are you attacking management, and then where can the FMS kind of fill in the gaps. And that's all about a demo.
Yeah.
We are up on time, so let me just run through the last few here. Performance drivers on revenue. This is for operators that are in the room here. If you don't have a street rate strategy or some way to do dynamic pricing, I would go end this call right now and go try to find a way to do that, unless you've got somebody in store and that is the best use of their time. ECRI program, same thing. They go hand in hand. Have somebody be responsible for rates, and make sure that you are pushing rates on tenants every month. Not the same tenant every month, but the tenants that are eligible. Just run the process, do it. It could be $10, it could be $12, it could be 10%, 5%. Just push it when you can. Collections, I think AI is the opportunity there. Unless you've got somebody idle at the store, I would go and try to find an AI agent to make those calls or send out those text messages. And if you don't feel like doing that, set up your FMS. Go in now and make sure that you've got you actually do have notifications sent out to tenants, both in advance of a missed payment if their card is expired, and once they are past due. Just to call out one thing on visibility. Paid in local search. Look, Google Ads, if you're not running Google Ads and you have an occupancy problem, you're not doing everything you can be doing. You just have to play the game. If you're full and you don't need it, great. Then you're in a great position, and you should probably be running ECRI and drive down your occupancy by pushing up your rates, and then run paid ads. That'd be my takeaway here. Is any kind of silver bullet or something to that extent that you think is worth kind of taking away from this call, Scott?
I think first of all, paid in local search, I'll just add one thing onto that, and that is, geofencing, making sure you have a good company or somebody on board that understands that, getting it down to the micro level so that people find you when they're looking. But at the end of the day, when you look at these things, if any of you are feeling, any of you owner operators out there are feeling a little anxiety after this, well, then search which items that we talked about that where you have anxiety, and dive in and figure that out. And also go back to, it's a mantra around here, but also a book. It's the who, not how. And if you don't understand, one of these pieces, many of these pieces, if you really just don't find yourself in an operations piece, you are the investor. That is, you're the hunter, you're not the farmer. Then find a farmer, hire a farmer, hire a white label to handle these things, and don't wait. Don't bury your head in the sand. Don't sit here and watch another webinar and just assume that by osmosis this stuff is going to happen. If you've got an execution problem, which as Peter and I just pointed out, most of the time it is, but you're not the person to march it out, or you're just going to kick it out to the next day, to the next day, to the next day. Then stop and figure it out, and then find the who's going to be able to be responsible for those numbers or this area that maybe you're neglecting.
Perfect. So go, I just wanted to highlight this last slide. Go audit your facility, or if you're looking at a new facility, make sure you do a physical, digital, and data audit. These slides will be available for folks. You can reach out to me at peter@whitelabelstorage.com. Scott, I don't know, what's the best way to reach you?
Yeah, Scott@selfstorageinvesting.com.
Perfect. Hope you guys enjoyed it, and thanks for joining in the middle of your summer.
Thanks for having me, Peter. Thanks, everyone. Talk to you all soon.
Thanks, Scott.